Good afternoon and good evening for some of you. I'm Kathleen Stephansen, GIC's board chair, and I would like to welcome you to today's executive briefing. Today's event is a special College of Central Bankers presentation. The College of Central Bankers, established back in 2018, continues to enhance GIC's position as a leader in international dialogue. The college strengthens GIC's connection with former leaders of the world's central bankers. So today is a conversation on monetary policy and the outlook for the economy. And it is held in partnership with the Fundacion Rafael del Pino. Joining us from the foundation is Vicente Montes, the director of the foundation, and he would like to say a few words of welcome to our guests and attendees. Vicente, please go ahead.
Thank you very much, Kathleen, for your kind words. The Rafael del Pino Foundation is delighted to continue our partnership with the GIC, an institution with which we share the common objectives of disseminating knowledge and fostering leadership globally. Well, ladies and gentlemen, dear friends, good morning or good afternoon to you all. It's a great pleasure for me to welcome you to this virtual meeting. Today, we have the privilege of a unique conversation, and I want to begin my words by thanking the speakers for their efforts and participation today. And of course, it's really an honor to have in attendance such a fine representation of experts who are willing to share experiences and ideas in order to better understand the links between monetary policy, economic growth, inflation, and employment. At the foundation, we are convinced that innovation and entrepreneurship constitute a powerful source of social progress. We see those ideas as central to the strengthening of the leadership of current and of future leaders. Today, in a world transformed by an exogenous shock, not only for the present, but also for the foreseeable future and perhaps the distant future as well, the disruption of health services globally and the drop in GDP have occurred with an intensity and speed unprecedented since the end of the Second World War. The massive fiscal stimulus announced around the world, and in particular the packages developed by the US and Europe, are also unprecedented responses. But what's the role of monetary policy? What should its contribution be to economic growth and employment? This is the key question that this meeting of the College of Central Bankers will answer with the expertise of our guest speakers. The future depends on an optimal combination of both policies, fiscal and monetary, and of course on the initiative and drive of our entrepreneurs. But the basic components of these plans must enjoy a high degree of consensus among the different political, economic, and social agents so that growth is long-lasting. The events and the issues that we have just presented in general terms are going to be explored more deeply by the accredited people that we have with us today. So that's all I would like to say, except to finish by once again thanking Kathleen and all our friends at GIC, and saying how delighted we are with this event in partnership with you. Of course, our special gratitude to Vice President Paulson and President Lockhart for being so kind to join us as guest speakers in this session. And last but not least, we appreciate all the attendees for your participation. Thank you very much.
Thank you, Vicente. And, just as he mentioned, today's discussion, we are joined by Anna Paulson and Dennis Lockhart. So Anna Paulson is Executive Vice President and Director of Research at the Federal Reserve Bank of Chicago. She leads the bank's research and policy analysis work, overseeing the department that provides analytical support for monetary policy making and conducts research on banking and financial markets, also macro and microeconomics and the regional economics. Anna has also responsibility for the bank's public affairs and community and development and policy studies departments. She attends meetings of the Federal Open Market Committee, otherwise known as the FOMC, the group that is responsible for formulating the nation's monetary policy, and she serves on the bank's executive committee as well. Anna received a Bachelor of Arts from Carleton College and a PhD in economics from the University of Chicago. Dennis Lockhart was inducted into the College of Central Bankers in 2019. His career includes time in the private sector, government, and academia. In 2017, he stepped down from the position of president and CEO of the Federal Reserve Bank of Atlanta, a position he had held for 10 years. In that role, Dennis served on the FOMC as well, and his tenure spanned the financial crisis, the Great Recession, and of course, several years of recovery. In 2018, he completed a year as a senior fellow in the Mosavar Rahmani Center for Business and Government of the Harvard Kennedy School. And he is currently a distinguished professor of the practice at the Sam Nunn School of International Affairs at Georgia Tech. He was educated at Stanford University and at the Johns Hopkins University School of Advanced International Studies, otherwise known as SAIS. He also attended the Senior Executive Program at the MIT Sloan School of Management and served as an officer of the US Marine Corps Reserve. So, you know, what's really amazing, at least for me, is the fact that you both have attended, directed the FOMC. So for a practitioner in economics, in the financial industry, where we spent hours dissecting the names, the words, the commas, the full stops, you know, this, I'm really looking forward for what you will be saying. Of course, that's in the past for me and probably for you, Dennis, but not for Anna. So with that, welcome to both of you. And we are looking forward for this discussion.
Thank you, Kathleen. Anna, with your permission, I'll jump in here and get us started. I think what Kathleen is saying is that if I play my cards right, we can figure out what dot Charlie's dot is in the dot plots. Since this is a sort of an armchair chat, I'm going to defer to you and ask questions because as an outsider now, I do have some insight, but I don't know exactly what people are thinking was inside the Fed, and I think you're in a position to give us a much greater acuity of insight into monetary policy matters of the day. I think this group, being following the Global Interdependence Center and their College of Central Bankers, is very interested in sort of how policy is formulated and what the current thinking is in terms of strategy. I thought we would spend some time on that. But everyone is interested in the outlook. So let's start with the outlook. And I'll throw a question to you and then maybe add some of my own views. And the question is, where do you think the economy is today? Where does it stand? And what's the near-term outlook? What's the outlook or the forecast of the Federal Reserve Bank of Chicago?
So thank you, Dennis, and thank you, Vicente, and to Kathleen, and to the Global Independence Center and the Fundacion. I was reflecting on interdependence today, and it's, you know, pretty important word for all of us these days. I think we're realizing how interdependent we all are in new and profound ways. So Dennis, I'm delighted to be here to have this conversation with you. So thinking about the outlook, I think, you know, I want to take a step back and then look forward. So looking back, right, this has just been a horrific year for so many people who have been, you know, faced illness and death and uncertainty and unemployment. And, you know, there's been a lot of suffering, and the economy, of course, suffered too. things were looking pretty bleak in March and April, and the US economy, along with the global economies, rebounded sharply. And we've made a lot of progress, and a lot more progress than we probably thought we would have, say, 6 months ago. From this vantage point here, when we look ahead, we're kind of on this precipice of optimism in the US as vaccines roll out, and we have kind of a chance to get a handle on the epidemic that's been, devastating economic activity across the globe. So when we look at this coming year, things look really strong, right? I think the median FOMC projection for GDP is 6.5 percentage points growth in 2021. And it could be higher, right? There's accommodative monetary policy, there's a lot of fiscal support, and then there's the very critical factor of the prospect of getting the pandemic really under control. Unemployment is still very elevated right now, right? 9.5 million people are still out of work relative to where we were prior to the pandemic. I expect there to be a lot of progress on the employment front this year. Employment could end the year, below 5%. The median dot plot again has unemployment at 4.5% at the end of this year. There's a lot of progress to make up in the leisure and hospitality and retail sectors, and just particularly those areas where it's been difficult to operate as normal as, people want to avoid close personal contact. And so I think there's going to be a lot of progress this year. Household balance sheets are in good shape. The manufacturing sector has almost made up, almost gotten back to where it was pre-pandemic, and prospects for demand returning this year should really strengthen the outlook.
I ask some of my former colleagues in the Fed frequently whether you have an epidemiologist on staff in the Fed, or how you make a forecast which is fundamentally based on some kind of a forecast of the public health situation. I try to follow this as best I can. Obviously I'm a layman, and I dare say many people in the Fed would consider themselves in the same boat as a layperson. But I do pick up now some cautionary comments about the interplay between variants of the COVID infection and the speed with which the vaccine rollout is taking place. And I still kind of hear a little bit of cautionary comments on the part of the talking heads on these subjects about the race against time that we are still in to some degree. Do you factor into your forecast some set of assumptions related to how the public health situation will play out?
I mean, you have to right now, right? The virus is very much in charge of the economy, and so whether it's explicit or implicit, right? You have to take into account what you think the progress on the virus is going to be and what that means for economic interactions. We're probably following the same news, but there's a bunch of states where caseloads are going up, and a couple of places where even hospitalizations may have gone up, and so there's some caution there for sure. And we have been, I think we've all become armchair epidemiologists and very reliant on the experts. At the Chicago Fed, we're lucky to have a couple of folks who are experts in health economics, and so they've been helping us a lot to parse the expert commentary from the epidemiologists and which data are reliable. I think one of the challenges for forecasters everywhere and for ordinary people too is that a pandemic and a disease that can replicate so quickly means that we can't, sorry about that, means that, we're used to kind of extrapolating linearly, right? Like we're good at that. We can go, here's one point, here's another point, let me draw a line between those two. But the pandemic does not behave that way, right? We see this sort of, things take off and then they slow down, they come back. And so that, I think that is a really important note of caution as we think about the variants, the pace of vaccines. The vaccine supply has grown a lot, and that's very encouraging. Here in Illinois, we're still very much in the part of, people checking, at 6 a.m. in the morning to see if Walgreens has released any new appointments, and scrambling to get, to see where people can get in. But, in a few weeks, hopefully that's going to turn to more like, hey, everybody is eligible to get the vaccine. How do we encourage people to get the vaccine? And it's something that people need to do, not just for themselves, but for their neighbors and for their community, because that's how you achieve herd immunity, which seems to be so critical in all of everything that we read about what it's going to take to get the virus under control.
All that said, I'll say I share your on-net optimistic view of the coming months, the rest of the year, and that will carry over into 2022. I do pick up when I listen to Fed speakers, particularly Chairman Powell, some sense that there could be a long tail to this recovery, that we will have made up a great deal, but not all of what was lost last year, and that you could end up sort of in a long slog, and therefore policy needs to be patient. On that question of a long tail, particularly for the lower income cohort in society, the people most affected, including women and minority groups, what's your view? What are the prospects for full recovery versus 98%, but still a long slog?
So I think I think it's probably not going to be a one-size-fits-all kind of answer to that question. So on the one hand, a lot of the folks who are currently unemployed are in leisure and hospitality, right? And some of those jobs had been the share of the economy that had been employed in that sector had been growing prior to the pandemic. So that suggests that there's some sort of strong underlying fundamentals, and that sector should be poised to kind of come back and bring workers back. But, it's not like people are just sitting at home waiting for the phone to ring and to say like, hey, come on back to the job, right? I mean, this has been going on now for a year. And so some people will have found other jobs. They will, they're not going to be connected to their current employers. Employer needs may have changed. And so while I think there'll be, it's easy at the beginning to bring workers back, as the recovery continues, it may get more difficult, and there may need to be some shifts, right? So we don't really know yet if there's going to be longer term damage from, or longer term shifts in activity from the pandemic. So, a big conversation, in my own workplace, and I think in many workplaces is, well, what's the new pattern of work going to be? Are we all going to be going back to the office 5 days a week, or is that going to be 2 days a week or 3 days a week? Those changes in commuting patterns and where we work and how we work can also drive changes in, where does that dry cleaner want to locate? Where do we need, restaurants to feed office workers, and things like that. And so I think we'll see some of that, as we go through this year, how much friction is there going to be as we reopen, and how much have people's behaviors change for the long term versus for the short term. And I think that, you know this very well, Dennis, like after the great financial crisis, it took a really long time to bring some workers back into employment. And as the recovery continued, we made additional progress in bringing down the unemployment rate for Blacks, for Hispanics, and lowered the gaps between whites and Blacks in terms of employment levels. That progress is really important, and I think that's one of the things that, when the Fed talks about inclusive employment, thinking about, how do you, what kind of monetary policy helps support that type of recovery that brings benefits to all?
Yeah, I think one of the bitter realities of the situation we're in is that we were very close to the promised land last February or January of 2020, and so close to a real substantive definition of maximum employment, and then it was destroyed in a month. And the historians will no doubt write about this. Let me suggest that we step back and talk a little bit about the monetary policy strategy framework, which was revised last year, in August of last year. And in my way of thinking, there are some pretty profound changes and implications of some of the language that was published to explain the new framework. And I'll point to a couple of things. First, employment, the terminology was used that the working definition of the committee in terms of maximum employment is broad and inclusive. And that word inclusive to me carried a lot of meaning because it reflected attention to subgroups in society and their participation in the workforce and their employment experience. And then, of course, average inflation targeting. That is a, may sound very arcane to many people, but is potentially a significant change, again, in my view, because it suggests that the committee will tolerate an overshoot of the 2% inflation target, perhaps for some time, conceivably for months and even a few years. And that translates into this expression, run the economy hot, that the committee may be willing to run the economy hot. So I've teed this up for you, Anna. What do you think is important about the strategy framework revisions?
So let me take a step back and talk a little bit about what motivated the review of the long run strategy first, and then tackle some of the specific questions that you raised. So the Fed embarked on a review of its long run strategy probably 18 months, 2 years before it was announced last August. And some of the things that motivated that review, really occurred when you were on the FOMC, Dennis, right? So we have seen a long sort of structural trend in interest rates across the world becoming lower and lower, right? Which raises risks of the zero lower bound or the effective lower bound on interest rates. So that calls for, you have to think about what the implications of that are for monetary policy. And those are really driven by structural factors, right? That has to do with changing demographics, the demand for short-term assets, things that we think are going to be here for quite some time and are unlikely to have been disrupted by, say, the pandemic. And other factors were that experience in the recovery following the great financial crisis, where we saw really low unemployment, record low unemployment that, as you mentioned, was bringing Blacks and Hispanics into the labor force in ways that we hadn't seen for a long time. And that period was accompanied by below target inflation. So inflation that was below the Fed's 2% goal. So that really challenged some kind of, received wisdom of central bankers that there's this profound trade-off between unemployment levels and inflation. We had record low unemployment without seeing problematic inflation. In fact, we had inflation that was too low relative to the FOMC's target. So all of those factors went into the framework review and are reflected in what comes out of it. So, we can think about, we don't need to think so much about, gosh, unemployment could be too low. Let's just worry, let's just worry about if it's too high. Let's try to get to maximum employment and just be worried about shortfalls from employment. So that's a big change, I think, in the FOMC's, in the way the FOMC thinks about employment, right? So a lot less concern about, as you termed it, kind of running the employment hot. Inclusive is another way of kind of getting at that same idea, where you're thinking about, the longer that we could sustain a recovery, the more people we can bring into the economy, and they can reap the benefits of being employed and all that comes with that. And it's also a different way of thinking about slack in the economy, right? Not looking just at one aggregate number, but looking at a host of numbers, and then looking at, unemployment for different groups, is another way of thinking about, like, well, there must be some slack here. And so, maybe monetary policy can stay accommodative, and firms and businesses can adjust and help bring more workers into employment situations. Let's see. So you also asked about the average 2% inflation, right? So the long-run framework says that, you know, given the risks of the effective lower bound, right, which effectively, you know, pull inflation down a little bit, right? Because when there's a shock that reduces aggregate demand, it's you know, it's harder to provide the kind of accommodation to boost aggregate demand and get inflation back up. And so there's kind of this downward drag on inflation from the effective lower bound. So you've got to counteract that somehow. So that means that when times are good, you want inflation to be a little bit higher to make up for the times when it can't be so low. And all of that is in the service of anchoring inflation expectations at 2%. And so that's the really critical thing about averaging 2% is, you know, kind of a viewpoint that if you've missed on inflation to the downside, then there's a risk that inflation expectations have kind of drifted down, you know, and especially in the context of the effective lower bound. And so you need to, you know, achieve inflation that's above target for a little while to pull them back up. But again, you always want inflation expectations to be anchored. That's an important part of you know, managing the risks of inflation being either too high or too low.
Let me ask, I'd like to get into the weeds a little bit more about how average inflation targeting is actually going to be implemented. I get the question frequently, gee, it looks like inflation is going to rise. Is the Fed going to get trigger happy and raise rates very quickly because of early indications of inflation? And my answer is usually no. I think the FOMC will be quite patient, actually. And part of it has to do with the sheer accumulation of evidence that the underlying fundamental inflation trend is at a certain level. We would hope at 2% or maybe a little bit above 2% for a while. It takes time to accumulate that data and that evidence. The committee doesn't want, I believe, doesn't want to react prematurely to simply 1 month's numbers or 1 quarter's numbers, which can have transitory elements in the inflation picture. And when you look at expectations, I picked up from a speech that Governor Clarida made recently that there's also a dashboard of inflation expectations with 15 or 20 different indicators that you are now looking at to determine where expectations may be. So how are you going to actually implement in real policy making this average inflation targeting regime?
So I think that you see the new framework in action through the FOMC's recent policy statements, right? So the FOMC has said, look, employment's too low, inflation is too low, we're going to be very patient. What do we want to see? Rates are at 0 right now, and they're going to stay at 0 until we reach the maximum employment goal, until inflation gets to 2%, until it's on track to exceed 2%, moderately for some time, right? So that's really sort of saying, like, here's the deal. It's too low now. We're trying to get it. We're going to be very accommodative and patient until inflation gets to 2%. And then, we want it to be above 2%, moderately above 2%, for some period. And then I think there's not a mechanical formula. And really there's judgment involved in how long does inflation need to be above 2% in order to anchor inflation expectations at 2%. And so there's going to be different viewpoints on this. And, inflation expectations aren't something we can observe directly. We have a dashboard, as you say, of indicators. There's a lot of things that we can look at, but they are all, something that's fundamentally unmeasurable, right? So we look at surveys of financial market participants. We look at surveys of households. We parse the financial data to try to figure out, which component of yields is telling us about inflations, which ones are about risk premia, which ones are about expectations for real activity. There's a whole bunch of things that we're looking at. This year's going to be kind of interesting and tricky for parsing those things, right? The economy collapsed last spring, with like a rapidity that we've never ever seen before. And that was a deliberate policy move, right? Of course, to protect households and families from the disease. And then it's opening up and growing really quickly too. And some sectors have been doing pretty well, you know, ones where social distancing is possible, interest rate sensitive sectors, and others that haven't been doing so well, right? So you've got demand that's kind of high and is projected to grow in some sectors. And then in some other sectors, it's starting from another place. So there's gonna be, you know, inflation this year, right? Measured inflation is gonna go up for a bunch of different reasons. Some of it is gonna be mechanical. The low readings from last spring are gonna drop out. There's gonna be kind of, you know, supply and demand are not gonna get to the same place all at the same time. And so it's gonna take time for supply chains to get reformed and to be, you know, adequate to the new levels of demand, you know, open up that hotel, open up that restaurant, bring workers back. And it could be that, you know, people want to fly before the airlines are, you know, fully ready to fly, things like that that are going to drive price mismatches. But a lot of that is likely to be a phenomenon that's relatively short-lived as we go from, you know, still having activity very restricted to, you know, hopefully the virus situation allowing people to return to much more normal activities. And so then the real question is, what do we think happens after that? How much of that inflation that we're likely to see will be sustained beyond, you know, next year and maybe a little bit into 2022? And that depends on so many different things, right? It depends on monetary and fiscal policy. It depends on how inflation expectations are formed. How does that experience of seeing price rises make its way into price setting behavior and wage setting behavior of businesses and the expectations that individuals have for how much their wages should grow and, you know, how much they bargain over those wages and so on. So there's a lot to, and then of course we'll see the data come in too, right? But we'll learn a lot over this coming year, I think. But it is going to be a tricky year to figure out what's short term and what's kind of a one-off transition increase in prices.
Let's just take one quick second, because I think there's another burning question on the minds of our audience probably and the general public, and that is, when does desired inflation become undesired inflation? At what level? And this is a matter for debate. When I was in the Fed and in the FOMC, I would have answered that question at say 2.5 or 2 3/4%, maybe as high as 3%, but not for long before I would begin to get nervous as a policymaker. You know, I'm just going to ask you for a quick question. Do you have an answer to that question of what the threshold is between desired and undesired?
I do not have, like, you know, I've been well trained and I do not have like a simple answer to that question.
You're a very good central banker.
I mean, I think that there's, you know, you could imagine like maybe higher for a shorter period of time, a more moderate pace for a longer period of time. You know, I think the, you know, if you step back and you think about like the last, you know, 15 years or so, we've had below 2% inflation for a really long time. I'm much more worried that inflation expectations have drifted below 2 than I am that they're anchored at 2. So I think that we need some time to, you know, the FOMC should be looking for policies that are gonna, you know, deliver on the mandate, deliver on the long run framework, and really anchor inflation expectations at 2. So I think that means being moderately above for some time. And, you know, the risks are really asymmetric as well, right? If inflation does get higher than is comfortable and is appropriate, you know, in service of the Fed's mandates, then, you know, the FOMC can easily remove monetary policy accommodation if that's appropriate. It's more difficult to provide additional monetary policy accommodation in our current situation.
Yeah. Let's shift to the balance sheet as a tool. We don't have much time left, and there are a couple of things I think we really should cover. And so what we're talking about when we talk about balance sheet policy is bond purchases. Quantitative easing is the expression that has been used. The level of reserves in the system. And, you know, I've studied the theory on this. I've listened to some of the deepest thinkers in the Fed talk about how far we can go, but I'm curious what your view is. Is there a limit? You know, are those of you in the room thinking in terms of a limitation to how much the balance sheet can expand and the appetite of banks for reserves, or is it truly infinite?
So I think that the FOMC is very focused on the dual mandate goals that Congress, gave the Fed, right? Gave those responsibilities. So maximum employment, stable, low inflation. And so it's using all of its tools to try to achieve those goals. In March of last year, financial markets were very disrupted, and the Fed started buying treasury assets at a pace of $80 billion a month and mortgage-backed securities at a pace of $40 billion a month, first to support markets and then to provide monetary policy accommodation. And those actions have continued, and they are certainly, one of the factors that's holding, keeping financial conditions accommodative. In the absence of those purchases, one would anticipate that longer run interest rates would be a little higher, and the lower interest rates have been really facilitating the recovery, right? Helping people go out and buy cars, finance and refinance homes, helping businesses to borrow and invest. And so those balance sheet policies are providing important accommodation together with low short-term rates. We were always going to be evaluating whether or not the financial sector can, is being distorted in some way by those purchases. But I think it's really important to consider those potential costs or those potential issues relative to the goals of achieving the dual mandate, right? So there's some really big trade-offs there, right? And certainly the dual mandate goals have to be front and center, and then the balance sheet policies are a tool to achieve them. And everybody's watching that very carefully. Thus far, things seem seem to be working out very well, and the asset purchases are providing important accommodation.
Let me finish this subject of the balance sheet with a view, and I'll ask you to kind of react to it. I get the question frequently whether we should expect yield curve management or yield curve control policies to be implemented, whether the Fed will change the composition of its purchases to try to suppress the rise in longer term rates and so forth. And my answer is that tool is available, and certainly no one is going to disabuse the public that it could be used. We've done that in the past after the great financial crisis and during and recession. But my view is that the Fed will react when you think your forecast is being jeopardized, and when financial conditions are tightening in an unwanted way, and therefore imperiling the path of the economy in some way. Otherwise, the tendency would be to hold off and not use that tool. Reaction?
So I agree with that assessment, right? We've seen longer term yields come up, quite a bit just in recent weeks. And so what's notable there is the speed of the moves, not so much the levels, right? The levels are still, pretty similar to what they were prior to the pandemic. Overall financial conditions remain very accommodative and supportive of economic activity and the recovery. And so, it doesn't seem like the yields at this point to anything that the Fed would need to respond to. In fact, some of that move up in yields, I think, is an assessment on the part of financial market participants that the outlook is brighter, and that's a good thing, and that's something that we should be looking for and to celebrate, really.
Let's just spend a minute. I think Kathleen's about to intervene with questions from the audience, so I'll make this very quick.
Okay.
Because I don't think we would have done justice to the topic without commenting on financial stability risk. Mm-hmm. And the critique, widely viewed critique, is low interest rate policy encourages speculation, encourages search for yield, and leverage in the system, and that all adds up to actually the Fed contributing to the risk of financial instability. My own view is that it's a necessary consequence of broad accommodation to support the overall economy, and it has to be managed, which I think the Fed does a decent job of doing. Anna, you want to make any comment on that? I think this is one of your specialties within your own economics practice.
So I think a lot about financial stability risks. And when I think about financial stability risk in the context of what the FOMC's goals are, I think it's really important to remember that low and stable employment, low and stable inflation and low unemployment, getting the economy to be at potential is a net plus for financial stability, right? Like that's a really important perspective to have, right? So when people are employed, when businesses are operating at full capacity, they're in good places to service their debts, and their balance sheets are healthy. Banks have good opportunities to support, as do investors. When interest rates are low, that can certainly change incentives, and there are definitely financial market players that have to be concerned about the level of nominal yields, and so they may be searching for yield. Some of that is kind of the intended policy a little bit, right? We want to encourage a little bit of risk taking because that encourages the type of investment that brings back jobs. But it always has to be balanced. I do think that the financial stability issues are, an indirect effect of first order policies that are designed and that, broadly support financial stability.
Good. Kathleen, over to you.
Well, thank you very much. And I have to congratulate both of you for having struck a really preemptive move here on inflation conversation, because I've received quite a few questions on inflation, and Anna, you have answered many of them. But just as a reminder to our audience, if you do have a question, just put it in the Q&A tab that you have at the lower part of your screen. So, one of the, I think one of the issues, you touched on the regime change, quote unquote, of inflation and the measuring, if you will, of it and controlling it. And you can argue also that, while this revision and review was taking place, the pandemic has accelerated quite a few trends here. But what it has done also is really reveal the profound vulnerabilities of our society. And to what extent, do you think, and this for both of you, do you think that the communication part of the Federal Reserve has kept in pace with this rapid change and challenge that we are faced with? I know that you have the tools and so on, and the goals, but the communication. Anna, perhaps you can start. And
So that's a really interesting question. I don't think I've given. I'm thinking about the answer right now. So the Fed does a lot of communicating, right? I mean, they're all the members of the FOMC who are out there speaking. And there's and a lot of, and there's very organized monetary policy communication, right? With the release of the statement, the press conferences, the summary of economic projections, and so on. That's all about, the aggregate economy and monetary policy. I think that the pandemic has also, so at least at the Chicago Fed, it's also been much more important for us to try to engage directly with the community. And I can't underestimate the critical importance of the intelligence and the information sharing we've heard from community and business leaders across the 7th District, right? When things are changing so quickly, your economic statistics are really stale. We've got lots of new data too that's sort of real time, but that on the ground information has been really important. And then I think we've done a lot of communicating. We have we have something called Project Hometown, where we've been trying to communicate directly with communities to hear from them how they're suffering through the pandemic, how they're coping, how they see things, and to think about things, policies that we can support or provide research that helps, people identify promising policies to help communities recover. So this is a little far away from monetary policy in some ways, but young people have been, really suffered during the crisis. Education has been disrupted in a big way, and at critical times in people's lives. And so we've been looking at policies like summer jobs that seem very, very hopeful for helping folks, especially, disadvantaged kids, to get on a better trajectory, and then trying to figure out how do we communicate that message to people who can create summer jobs or to drive those programs. So I think the communication at the monetary policy level has been important, but also really engaging with the communities, making sure we understand what people are actually experiencing, and then what that means both for for inflation, for economic activity, for prospects for recovery.
Okay.
Yeah, I'll chime in with a kind of narrow response to the question. I think Jay Powell as chair and other officials, including the presidents and the other governors, have a responsibility of trying to explain the path of policy and, to some extent, to not surprise financial markets. So signaling in advance. And I really think everyone's done a pretty good job. I have a problem with the hearing, the listening on the part of the financial public particularly. I don't think many participants in the market believe Chair Powell when he says, we're going to be patient, we're going to keep this policy, this accommodative policy in place until substantial progress. And last week in the press conference, he used the words achieved and complete. Mm-hmm. The job being completed. That's, to me, a meaningful shift to some extent. It means that it's not going to be a forecast of the future that triggers a policy action. It's going to be the accomplished goal that achieves it. And I take him at face value what the Fed is saying about their patience in terms of this policy stance. I don't think a lot of people in the markets get it, frankly.
Yeah, it's a good point you're making. So I'm going to, because we're bombarded by so many questions, I'm going to take two inflation questions and then we'll move on to some others. One is, what tools have been successful in the past to lower inflation without causing a recession? That's one, and then let's bundle them up. And the other question is, which is more important at the moment for the Fed's medium-term inflation policy today? Is it the price increase or is it rising employment costs?
Well, let me start with just a comment that runs a little counter to the first question, and that is, yes, the Fed knows what to do, and that was taught by Paul Volcker, and that is you jack up interest rates until you create a recession, and that's the way you deal with hyperinflation. Now, I think it's very doubtful that we're going to face another spell of hyperinflation. So the question is, if it gets into a uncomfortable zone, let us say above 3% on a persistent basis, or even higher than that, is there a tool that won't just bring down the economy? That's really the question.
Yeah.
Forward guidance, communication, these can be effective tools, I think. Signaling interest rate rises well in advance, maybe making interest rate rises not month by month, but just episodic. Those are ways of doing it with a little bit lighter hand than what Paul Volcker taught us.
But
So I would agree with that, right? I mean, the Fed has made huge strides in terms of transparency and communication since the Volcker era, right? I mean, there was a time, right, when the Fed didn't even tell the markets when they changed policy. And so we've certainly moved away from that. But I think, gradual and telegraphing is helpful. I mean, both in terms of, in terms of making the changes as incremental as possible, but also making them contribute to stability as opposed to kind of jerking from one perspective to another perspective.
But don't you think that 3% inflation, the markets will freak out, Dennis?
Probably freak out until they get used to the idea that it's a desirable thing for a period of time. Yeah, I've been following what I consider to be sort of alarmist noise out there about inflation, and I think it's premature. I actually, in my own thinking, rely on recent experience as an indicator of what is most probable in terms of an inflation picture. I think can be overreaction. The second question raises an interesting point. And if I recall the question, there was really a reference to different components of inflation.
Right. Yeah.
And I'll just simply make this point and maybe ask Anna to react. We don't necessarily have a well understood definition of inflation. In my mind, inflation is very broad. It is the overall price level rising at a certain pace. It is roughly analogous to the loss of purchasing power of the currency, the dollar. So when you talk about employment costs, or you talk about another component, you're just talking, you're not really talking about broad inflation. You're talking about elements in the picture. Those change all the time. And I think the committee has to discern whether the broad price level is rising at a pace that is acceptable.
Yeah, yeah.
So I would absolutely agree with that. And I would also kind of say, like, taking just a little bit of a step back, it's really positive that we're actually having a conversation where people are, some people are worried about inflation. They might be worried too much, but that's, in some sense, since we've been running inflation for so long, it's actually kind of healthy that, it's a good development that some people are actually worried that inflation could be too high, right? I mean, I think that's a sign of progress. Obviously, we have to, to walk the talk and deliver on the inflation goals, and people are learning about the new framework, and so that some of that is natural. When it comes to the elements of inflation, there's some price moves that could be, don't tell you very much about future price moves. Energy and food are classic examples, and so we look through those movements all the time. When I think about inflation and components of inflation that might be important to look at now, it's things that are more long-lasting and cyclical, right? So those are the types of things that you might want to pay a little bit more attention to see to see if they're going to they're going to the trends are starting that would continue beyond next year, and kind of the and the reopening of the economy. But really, right, we're looking for broad inflation, and so wages should be going up, other prices should be going up. This should be the entire economy should be experiencing a general level of price increases.
So I will pivot a little bit, bringing in the discussion the notion of fiscal policy, and then if we can then move on to a more regional economy for you, Anna. But first, in your mind, are budget deficits meaningful in forecasting economic growth and inflation? Or are you not necessarily that worried about these budget deficit levels, if you will?
Well, I'll take a whack at that question. It's a tough question.
Yeah.
I think you have to distinguish between the short term and the longer term. And the situation we have is, I think there's a defensible, there's a case for deficits in the short term to try to deal with an economic crisis caused by COVID, and to partner fiscal policy with monetary policy to get the economy back to its full functioning. At the same time, we're deepening a hole that will be more and more difficult to climb out of in the future from a debt point of view with these deficits. And Jay Powell, Janet Yellen, many people associated with the Federal Reserve and now the Treasury have said that picture is unsustainable in the long term. So you have a kind of short-term compromising of your view to get a certain outcome in terms of the broad economy, while at the same time recognizing this can't go on forever. It just simply cannot. And we are far away from a sustainable fiscal position. I do think that the deficit spending adds stimulus in various ways through various channels and will support a rapid recovery. And that recovery will probably come more rapidly than if we were dependent just solely on monetary policy.
Yeah, I would just add that if you look at, the progress that we've made over the last year, so leaving aside the fiscal stimulus that's to come even, that fiscal stimulus has been really critical for getting us as far as we have come since, the depths of, March, April, May, in terms of, protecting household balance sheets, allowing people to, continue to spend and support their families, but also support the economy. I think it's also important to recognize that the sustainability of the deficit also depends on economic activity, and so that the faster that we get back to full potential, then we've got that helps to restore balance. It doesn't doesn't address the long-term structural issues that Dennis is talking about, but it certainly helps, right? So this is in service of getting people back to work, getting businesses investing, and all of those things, ultimately, help make the debt sustainable.
Yeah. Thank you. And gosh, I mean, I realize time is flying here, but one last question for you, Anna. The Chicago Fed has close ties, obviously, with the auto industry. And so now that we're moving, towards or transitioning towards electric vehicles, how do you see the challenges with regard to the labor market, the local labor market in that industry?
So the auto industry is very important, for the entire country. And there are a lot of that is concentrated in the Chicago Reserve Bank district. And so we do talk to the auto companies quite frequently to try and stay on top of how they're doing, and these longer term trends like the move to electric. That is going to be a really interesting transition, right? You can, from what I understand, and these are like kind of exciting things to learn, combustion engines are super complicated and need lots of repair, and electric engines, are very simple and don't need to be repaired. So it really changes the entire, kind of automobile infrastructure. But I think those changes aren't going to be happening in isolation, right? There are these longer term, exigencies to really explore how we can, reduce, carbon in the atmosphere and all of that. And so I think that the auto sector is one sector that will be changing, but, the entire economy is presumably going to be adapting in some ways. And so I think we're going to learn, the auto industry right now is out in front, and these still aren't, developments that are driving the employment of large numbers of people. So much to come there, but hopefully the auto industry will provide a little bit of a glimpse of what's ahead. But really, this is going to be transformational, probably for the entire economy, and it will happen gradually and so on. So we have time to learn and to adjust, but certainly something to follow very closely.
And it goes hand in hand with the digitalization trend, and obviously this means more friction in the labor markets as we march on in that direction, presumably. Yeah. Dennis, did you want to comment?
Well, I'm not.
You're not in Chicago.
I'm not well up to speed on the auto industry. I'll point out one just little anecdote that I think is very interesting. And there's an auto manufacturing center in Georgia. I still live in Atlanta. It's in West Point, Georgia, where there's a Kia plant, and nearby in Alabama is a Hyundai plant. And the Kia plant was working on establishing battery manufacturing and battery plants. So maybe the transition will be to just a different element of the supply chain in autos, from assembly of complex engines to making the batteries that will go into a much simpler engine. So just one little anecdote.
Well, on that, Anna, Dennis, thank you very much for this great, very interesting conversation. And, you know, it would be nice to have you back, you know, maybe to have an update on all these various trends here. So thank you again. And I also would like to thank Vicente Montes and the foundation, the Fundacion del Pino, for their partnership in our program today. So we hope, in fact, that, you know, we all should be in person in Madrid in the not too distant future. So again, thank you so very much. And as a reminder to our audience, before we close this executive briefing, we have a little questionnaire to, if you can take 60 seconds to answer it. But also we have the replay of this executive briefing that will be available on the GIC website later today. Finally, the next executive briefing will take place on Thursday, April 7th. And again, we stick with the topic of monetary policy with Tom Barkin, who is the president of the Federal Reserve Bank of Richmond. And there the registration is available on our website again. So, you know, to find any of these video replays, to explore membership, and perhaps more importantly, to donate to the GIC, please do visit our website, which is www.interdependence.org. And again, you know, if you do take 60 seconds for our for the response for our audience survey, it would be great. We always like to have some feedback that is helping us to improve our programming. Thank you very much, and hopefully see you on April 7th. Bye-bye for now.